At some point this week, your paycheck will land in your account, and shortly after that, it will be mostly gone. Rent, groceries, gas, subscriptions you forgot you had, a dinner out because you deserved it. That's not a willpower problem. That is the natural, predictable result of how money works relying only on a paycheck. Let's start with something you can feel. Your money doesn't go as far as it used to. That's inflation. Food prices climbed roughly 3.45% in 2020, then spiked nearly 10% in 2022, one of the sharpest jumps in decades. Do the math, and a $20 grocery run from 2020 costs you roughly $25.32 today. Same cart, more money. If you have a mortgage, car loan, or carry a credit card balance, you felt borrowing get more expensive directly. Wage growth is barely covering current inflation and nowhere near recouping the cumulative price increases from years prior. Here's where the story changes. The thing that erodes a paycheck's value multiplies the value of an investment. Long-term data shows diversified stock market investments have returned somewhere between 10 and 11% annually over time. Your salary grows slowly. A portfolio grows 2 to 3 times faster. That gap is where real wealth gets built. When you invest weekly, you put money in regularly regardless of conditions, smoothing out volatility over time. You put in money, check a week later, and the number barely moved. Your brain files this under not working. Compounding doesn't build in a straight line. It builds in a curve that barely looks like anything for years. By year 5, the gap between what they put in and what they have is growing faster than before. That acceleration is the curve. Each reinvested dividend buys more shares, which generate more dividends. The loop tightens. Stop asking, is this growing fast enough? And start asking, did I invest this week? That shift creates wealth. Look for diversification. Owning a wide range of companies so no single failure can derail you. Low fees are non-negotiable. Even a 1% annual fee quietly eats a significant portion of your returns over decades. Let's look at 5 fidelity funds that check every box: broad market, mid-cap, sustainability, growth in income, and dividend growth. Combining these funds creates a portfolio designed to grow in value while simultaneously growing what it pays you. Let's follow someone committing to $35 per week. It's the kind of amount that disappears from budgets without a trace. By year 20, his portfolio is generating close to $9,000 per year in dividends alone. The gap is unmistakable. After 30 years, he contributed less than 6% of the total. The other 94% came from the compounding habit. Here's the summary. Rely on a salary or build something that works for you whether you show up or not. FZROX owns large, mid, and small-cap companies across the entire U.S. market and charges literally zero in management fees. It currently yields around 1.04%, grows its dividend at roughly 7.55% annually, and has delivered approximately 13.5% annual appreciation. FSMDX specifically targets mid-size companies, businesses large enough to be stable but still with significant room to grow. It holds roughly 300 companies with a 2.42% yield, a strong 17.21% dividend growth rate, and 7.4% annual appreciation. FITLX invests in companies with strong environmental, social, and governance practices, a modern tilt toward momentum industries. It yields 1.14%, grows dividends at 13.74% annually, and delivers 13.06% in annual appreciation. It adds a forward-looking dimension. FGRIX splits the difference between reliable dividend payers and consistent growers, delivering on both fronts simultaneously. With a 3.13% yield, a 19.68% dividend growth rate, and 8.17% annual appreciation, it's one of the harder-working funds. FDGFX is the stabilizer. It targets companies with long track records of raising dividends and strong underlying financials. It yields 3.2%, grows dividends at 18.03% annually, and offers 2.78% in annual appreciation, making the portfolio more resilient. You don't need a large amount to start. You don't need to time the market. You don't need to pick winning stocks. You need a consistent habit, a low-fee diversified portfolio, and enough patience to let compounding do what it does best. If this gave you a clearer picture, share it. Leave a comment below with one question you want me to answer. And if you want to go deeper on a single fund that alone has the potential to build a multi-million-dollar portfolio, the next video is already waiting for you on screen. See you there. Markets crash, recover, crash again, and recover again. But the long-run trajectory has always bent upward, not through windfalls, not through perfectly timed trades, through that difference in growth rates applied consistently over decades. When markets dip, your new contributions buy in at lower prices. Over time, this smooths out volatility. In a world full of economic noise, that consistent participation is one of the few edges available to ordinary investors. Say someone invests $20 per week, $1,040 per year. After year 1, contributions total $1,040. Growth is real, but modest. By year 3, they've put in $3,120, but with dividends reinvested, the balance might be closer to $3,750. That extra $630 didn't come from their pocket. It came from dividends reinvested and time at work. By year 5, contributions reach $5,200, but the portfolio may sit near $6,850. The gap is growing faster. Broad market exposure means spreading across different company sizes, sectors, and styles, keeping you positioned regardless of what's outperforming. Proven performance means looking at funds backed by companies with real earnings growth and strengthening fundamentals, not hype cycles. To calculate the average portfolio dividend yield, add up each fund's yield and divide by 5 for an average of 2.19%. Josh commits to $5 a day. He splits it equally across all 5 funds, roughly $1 per day per fund. End of year 1, total contributions roughly $1,825. The portfolio isn't impressive yet, but the compounding engine is warming up. End of year 10, the portfolio is projected to reach around $32,000. Reinvested dividends are now making a visible contribution. End of year 30, projected portfolio value approximately $942,000. Monthly dividend income roughly $8,000. Break that down, and Josh put in $54,750 of his own money. The remaining value was created entirely by compounding. The remaining roughly $887,000 of his portfolio's value was created entirely by compounding, reinvested dividends, and decades of market growth. He contributed less than 6% of the ending portfolio value. The other 94% came from the habit, not from the amount. That's not a sales pitch. That's the math of time working in your favor instead of against you. Here's the summary worth remembering. Your paycheck grows in a straight line. Invested money grows in a curve. The gap is the difference between relying on a summary and having something that works for you, whether you show up or not. You need a consistent habit, a low-fee diversified portfolio, and enough patience to let compounding do what it does best. $35 a week is not a small thing. Deployed consistently over 3 decades, it's nearly $1 million in passive income. Leave a comment below with one question you want me to answer in a future video. I read all of them.